Good afternoon, everybody. My name is Sean van den Berg. I am an investment specialist here at PC Wealth. We're based here in Bryanston. Welcome to our webinar this Friday afternoon. As you can see there, the topic is called Introduction to Fundamentals and Investing. My objective today is threefold. Number one, to educate you about the fundamental analysis, and obviously because of time constraints, I'm going to go into too many financial ratios. But the main idea is to dumb it down, if I can use that word. And fundamentals, we talk about numbers. I always say it's quantitative, and what it means is that fundamentals is measurable. Okay, so that's number one, is for me to hopefully educate you guys. And then secondly is just to simplify the fundamentals. We'll be talking about macro and micro fundamentals. And what I also want to highlight today, very importantly, is just to highlight the tools, the research tools available on our website, the value filter, the company analysis, and things like that. Okay, so that's just a quick intro as we get going, and I see there's quite a few more people coming in. Okay, so when we talk about share market analysis, there's two schools of thought, and obviously next week we'll be going into more detail on what we call technical analysis. But the two big broad schools of thought is what we call fundamental analysis, and the other one is called technical analysis. But basically, to make money on the stock market, you need to answer three questions. And as you can see up top here, let me get my little highlighter here. You need to know, what must I buy, when must I buy, and when must I sell? So that question, what must I buy, is what we refer to as fundamental analysis. Okay, so that's what we're going to concentrate on today's presentation. But next week, as I say, next week Friday, we'll have another webinar. We'll be talking technicals and trading. That will answer the question, when must I buy and when must I sell? So obviously timing is a critical success factor there. But saying that, when we talk about fundamental analysis, you can look at, we break it down further into what we call macro fundamentals and micro. When I say macro, it's a big picture. And there's also two ways of looking at analyzing a company. You can use what we call a bottom-up approach or a top-down approach. Now, a bottom-up approach would be the macro approach. And there's two ways to look at that also. My view is just to be aware of all these figures, and I'll show you in the next slide what I mean by that. But basically, when we talk about a top-down approach, you as an investor would consider, as I say, the big picture when making your investment decisions. So you look at the broad performance of the economy. We just recently this week had our budget speech, midterm budget speech. We've seen GDP figures coming out, and there's a lot of unknowns. But the main idea is that you have a broad view on the economy, and then you're going to seek industries that are performing well within the economy. And within those different industries, or the ones that you think are performing well, you'll be looking at investing in the best opportunities or the companies within that industry. So that's what we refer to as a top-down approach. My challenge of that is there's a lot of variables, there's a lot of factors. So yeah, as I say, I like to just have a broad awareness. And on the next slide, that's what I'm talking about. And we refer to there's about 5 things you want to look at where we talk about macro fundamentals. So we talk about interest rates. You need to have a view: are interest rates going up or down? And if you remember, some of you might remember that we had a surprise interest rate cut in July this year, where the repo rate, which is the Reserve Bank's interest rate he charges, they charge the banks, dropped from 7% to 6.75. Okay, it was a surprise cut. Every 2 months, there's a group of people that get together. They call the Monetary Policy Committee meeting, and they decide what's happening about interest rates. It's all based on inflation. So that's the next thing you must be aware of. What's happening with inflation? We talk about CPI, Consumer Price Index, and you need to know what are the factors that are affecting all this. And by the way, I refer to tutorial number 4. where you'll pick up a lot of this information regarding these different factors. But inflation, relative to the Reserve Bank's target, is between 3 and 6%, and we've seen that slowly been edging up. In August, we had inflation at 4.56. In September, it edged up to 4.86. So it's still within that range, but there's pressure, especially now recently after the budget speech. We've seen that the rand has weakened. Last I saw this morning was about 14 rand 30. Imagine our biggest import is oil. So oil and petrol prices going up means transport costs will go up, and there's this whole knock-on effect, and that's inflation. Then you have to have, as I say, just now have a view on what's happening with the GDP, with the economy. Is it growing? Is it expanding? Is it above 4% or is it below 4%? And we saw our last figure, I think it was 2.5%. So we're still way off target, and I think they just downgraded, not the right word, downgraded, but they're anticipating economic growth to be much slower. And then have a view on the exchange rate. What's happening with the rand relative to the dollar? It's getting stronger or weaker. And I just mentioned it now, it's getting weaker. We're seeing that the dollar is very strong. Obviously, what's happening in America with regards tax cuts and economic growth there. And then obviously, you have to have a view on what's happening with foreign interest rates. And we've seen slowly in America that interest rates have been edging up. It's been rising slowly from 0.4%, and we're hovering around about 1.25%. But have a view. And then on the next slide, I think it all fits together. Remember, we're always stock market investors, relative to the stock market. And right now, if I bring my little cursor in again, relative to, if the stock market is above average performance, and that's where we are right now, we're making record highs nearly on a daily basis. Why? And the reason for that is in the past, we've had interest rates coming down. So the relationship of interest rates in the stock market is like a seesaw. As interest rates come down, the market goes up. Okay, and the reason why interest rates have been declining is because inflation has been declining. Okay, and the reason also, remember, I always say the Reserve Bank governor, they've got a tricky job. They have to keep their foot on the accelerator for economic growth, but also at the same time keep their foot on the brake for inflation. So you have to worry about stimulating the economy and things like that. And this is why every 2 months when they have these MPC meetings, they decide what's happening with inflation, but also, you don't want to raise interest rates too fast because it's going to stifle economic growth. So you'll find that interest rates have been declining on the back of inflation, but also because of a slowly below average economy. And as you find that the stock market is flying relative to other markets, you also find that our exchange rate will be strengthening. And yes, at this point in time here, we've seen the rand is weakening, but you'll still see that our rand hedges are benefiting from that. The companies like the Naspers of the world and the Richmonds and the Beshkemek Tobacco will be flying because on the back of a weaker rand, because their profits are in foreign currencies. And then lastly, obviously, declining foreign interest rates. Okay, that's in a scenario where the stock market is above average, and vice versa, when the market's underperforming, you'll find that the market comes down. Why? Because interest rates are going up, because inflation is getting out of control. So inflation is very important to have a view on that. Okay, I'm not going to go into too much detail on that, but as I reckon, please go click on this little link here and go look at our online tutorial number 3, goes into more detail about all the macroeconomic factors. Okay, so let's move forward. Let's talk about micro fundamentals, and this is where I believe it's just much easier from a quantitative and a qualitative nature, where you use technology to find the opportunities for you. So this is what I call the bottom-up approach. So you as an investor would focus your attention on a specific company rather than the industry or the economy, and you as an investor would assume that the individual companies can do well even in an industry that's not performing. Okay, so I'll go into more detail what I mean by that. So bottom-up investing forces the investor to first consider economic factors like the company's overall health, the company's financial health as such. You'll be looking at the company's financial statements. And from the company's financial statements, obviously I want to see if there's growth prospects, and also, as I say, the health of the company. So you'll be looking at understanding a bit more about the company, what are their products, what are their services they offer. And yes, at the end of the day, the share price will move up and down on supply and demand, but also you have to have a view on the supply and demand regarding the company's products and services. And then you'll be looking at a lot of other little factors too, but very, very broadly, you as an investor will be looking at these financial statements and looking at various financial ratios to compare one number to another number, usually the last reporting period compared to the previous reporting period, and see if there's growth. But if I just use it to simplify it for you, and those of you that are just starting out and are still new to the market as investors, I always say, if you had a magic wand, what kind of shares would I like to invest into? And then very broadly, and this is we're talking about strategy just now, but you might say, okay, I'm looking for shares that are undervalued. My little spotlighting again. I'm looking for shares that are undervalued. In other words, I'm looking for bargain. I'm looking for shares that are profitable, and I'm looking at shares that have manageable financial risk. Now, very broadly, there's more than 20 financial ratios to look at, but from a valuation point of view, now we'll be talking about a PE ratio and a PEG ratio. At the moment, the market's trading around about 21. It's quite high, historical. We're talking about a 10 PE. That's when the market's cheap. At the moment, around about 21. We're quite fairly valued, and sometimes there are pockets where we're very expensive. We go one step further. We like to use a PEG ratio, and I'll explain this. Here's our little guideline. I'm looking for anything below 75%, and this is I'll go into more detail on that. When it comes to profitability, one of the ratio to be looking at is what we call return on equity, and the guideline, I'm looking for companies that are making more than 15%. What's important here is it's sustainable. And then lastly, when we're looking at financial risk, one of the criteria we look at is interest cover. But the point I'm trying to highlight with all this here is that there's 5 or 6 criteria, 5 or 6 financial ratios that will help you sift through the market and bend the odds in your favor. So we talk about high probability investing. So you want to be in a situation, yes, me as a prudent investor, I want to be in a situation where we're making high rewards, but at lower risk. By buying into companies that are undervalued, profitable, with manageable risk, as well as also quality, I've got a higher probability of achieving, for example, my goal as an investor would be, from a capital growth point of view, to make 15% per annum. Obviously, also still got my dividend income on top of that. But if you're looking at aiming at 15% growth per annum consistently, I believe that every 5 years you should be doubling your portfolio. So I also use the analogy sometimes of prospecting for gold. Good old days, we used to pan for gold, going through a lot of gravel to find the gold nuggets. By using this criteria, I'll be looking for shares that are gold nuggets. So you're focusing your time on more, the better opportunities. And ultimately, you want to create a watch list of potential winners. So you don't have to watch the whole market. You're looking at only your watch list. And as I say, for example, you've got 25 shares and most of them meet this criteria. Trust me, you're in a situation where you got a high probability of making money. Okay, so let's move forward quickly. I'm going to explain to you what all these things mean. So the idea here, if I simplify it, move on to the next slide, it all starts with the basics. So we talk about a pie. I always say we want to buy into the share the company that is profitable or making pies. So just some of the terminology, in other words, that we use in the market, instead of using the word profit, we talk about earnings, but nowadays it's quite loosely interchangeable. They use it for both. But only a part or a portion, roughly about a third of profit, gets paid out in the form of dividends. The other 2/3 usually gets retained into the business, what we call retained earnings, and that's for future growth, either get rid of debt or for future growth going forward for the next year. But what's so important now, we want to try and calculate taking that earnings at millions divided by the number of shares in issue. When the company first listed, they had a certain number of shares in issue, and what we're trying to calculate in this scenario, and this is where it all starts, is what we call our earnings per share. So the idea here with earnings per share is I want to be able to compare a large cap stock to a small cap stock. Because why? The common denominator is what, as I say, is the earnings per share. I can compare the Anglos to a small cap company. Okay, so in our little example here, as I say, I'm trying to dumb it down. Let's say, for example, the company's got R1 million in profit and you've got 10 million shares in issue. 1 million divided by 10 million. In this scenario, my earnings per share will be 10 cents per share, 10 cents per earnings per share. Okay, so that's how it all starts. But now what's important is taking that number relative to the current share price. And this is where we come up with two of the earliest ratios. Those of you who ever looked at the share price page in the newspaper, you'll see these different columns. One of the columns is called earnings yield, and the other column is called price earnings ratio, or PE ratio. So here we go again. Here's our example. Bring my cursor back. So my earnings per share divided by the current share price. In this scenario, as a percentage, I'm looking at calculating an earnings yield. You can compare it really loosely to your savings account in the bank. Okay, so my 10 cents, my previous example, divided by the current share price, in this example, 1 Rand, 100 cents. In this scenario, my earnings yield is 10%. So the idea is you want a high earnings yield. If you want to compare that in the newspaper, want to compare one share to another share, want to go for the higher yielding share on earnings. It's like, as I say, the savings account in the bank. What would you prefer, 5% returns on your money or 10%? Yes, you want to go for the higher earnings yield. Now, the inverse of that, just swap them around, the current share price divided by the earnings per share. In this scenario, we calculate a price earnings ratio or price earnings multiple. In other words, how many times can I take the current earnings out of the current share price? In this scenario, I can take it out 10 times. Okay, so yeah, I want a situation where it's total opposite. I want a low PE multiple. Okay, so as I said, it's the opposite. What did you prefer? Would you like to take 10 years to recover your money out the market, or would you like to take 5 years to recover your money out the market? That's the way to look at it, very simplified. So I want to use 5 years. Okay. Now let's say, for example, the share price drops to 50 cents. So 10 divided by 50, what would my earnings yield be? In this scenario, it would be 20%. And obviously in this scenario also, if this drops to 50 cents divided by 10, my PE ratio would be 5. So if the share price dropped, it would be a screaming buy just based on those two financial ratios. The opposite occurred. Let's say, for example, the share price goes up higher, but the earnings still stays the same. So it goes up to 2 Rand a share. In this scenario, my earnings yield would be 5%. So again, as I say, what would you prefer? Put your money in the banks and get 10% or get 5% of the share? Or I'll put my money in the banks, risk-free. So in this scenario, also at 2 Rand divided by 10 cents as a multiple, to be 20 times. The share will be expensive. Okay, so that's the basics, and that's what a lot of people would be using when they evaluate a share. We like to go one step further and bring in and as an example, on our website, I know you're talking a lot about the tools on our website. You click on research and then search. Let's say, for example, and the average of the market right now is about a 21 PE. So I go click on putting PE 21, and I click on go. It clicks out a whole list of shares for me. This is a very long list. Okay, number one, you'll find that this list has very low PEs and very high PEs. And also you'll find that there's different quality shares. We're talking about different quality shares. So what happens now in this scenario, just using a PE, you'll still be confused and saying, okay, what shares must I choose? So what I've done now, just to emphasize the point, I've just taken a quick screenshot or grab of that, and I've blown it up. So those little 5 stocks, remember this list is much bigger. So there we go. So two shares, very much similar price earnings multiple, 12.9 for Accentuate and 12.5 for AECI. Okay, what I'll highlight for you is the price. Okay, so they're very, very similar price PE ratios. Look at the price. A lot of people default and look at the price now. It's okay, this is 78 cents share and this is 103 Rand share. And they go decide, okay, let me go buy the share on price. Now, this is one of the big mistakes a lot of people make. Never buy a share on price. Warren Buffett, the #1 investor in the world, says, is an old quote of his, says, price is what you pay and value is what you get. Don't just decide to buy a share on price. Okay, a 500 Rand share can be cheap relative to its earnings, and a 50-cent share can be expensive relative to its earnings. Okay, so that's what I wanted to highlight for you guys. So I want to go one step further now. What is the difference? So is there a better way? Yes, there is, and that's where the PEG ratio comes in. And this is where we bring in growth. So just the same example again, you've got 2 shares, one trading at 1 Rand, one trading at 2 Rand. Both have the same PE ratio. Okay, so as I said, a lot of people default to the price. You think, okay, I'd rather go buy the 1 Rand share. It's got a better chance of doubling to 2 Rand than a 2 Rand share doubling to 4 Rand. No, don't go on that. What's important is bringing in what the anticipated or expected forecast growth will be. Now, this scenario, share #1 is growing its earnings by 30%. Now, you divide the 15 by the 30% growth, you get what we call a PEG ratio of 50. We consider that very, very cheap. Okay. Whereas share #2, 15 divided by the 10%, you get a PEG ratio of 150. Now, that would be expensive. I hope that makes sense to you guys. Now, if you go one step further and say, okay, let's look at the sector. Now, the sector is also at 15, but it's growing its earnings at 20%. The PEG ratio is 75. We still consider that as value. Okay. So relative to the market, we say, okay, there's opportunity here. So what is the PEG ratio? If I had to simplify it or give you the formula, it's a P ratio divided by the forecast average growth over the next 5 years. Now, you don't have to worry about that because the website does it automatically for you. We take 2 years back and 3 years back and we forecast 2 years forward. So it does it automatically for you. And what's nice about it is that it's all color coded. I always joke, we got this whole thing, paint by numbers. Yeah, you got to invest by color. You want to buy, if you look at the legend here, you want to buy into undervalued companies. Okay, if you look at long-term valuation, the PEG ratio, you want to buy the greens, avoid the reds. The reds are overvalued stocks. Why? Because financial risk will be high and the quality rating will be lower. This is the kind of ideal stock you're going to look for. Shares that are undervalued, have no debt or manageable debt, and the quality rating is the highest. Most of the market right now is fairly valued. If you look at, you'll see the future slides, most of the shares are yellow. They have manageable debt or low debt, and the average quality rating right now is about average. Okay, so the point is, what I'm trying to highlight using the PEG ratio is you not only select companies with a very low PE as such, but those companies with a PE ratio that is low relative to their forecast earnings growth. Okay, so remember, growth is what's important. So PE, G stands for growth. So we're trying to target the better companies trading at low PEs, and this is where it's so powerful. So earnings rate growth must be higher than the PE ratio at the time of investing. So that's what it's all about. So going back to our website, and this is a tool you can use. You can say, okay, let me bring into that same list we saw just now. What I'm bringing is another column now. I'm looking at the PEG. As you can see, there's a red, there's some greens, and some yellows. Okay. So in this scenario, again, our previous stock, remember we said, okay, we're looking at 78, they're both the same PEs. Now you bring in the earnings growth, okay, and you see now the colors. Now this 78-cent share is expensive. You can see it's colored in red. It's overvalued. That's not sustainable, that kind of growth. It's only growing at 7%. Okay, whereas AECI is growing at 12%, but it's still, you can see the color is fairly valued. So it's not a screaming buy. So what I'd rather be looking at is these other stocks. Bring my cursor in again. There's a 50, there's a green, and there's a green. Okay, so I'd rather look at better quality stocks. Better value stocks. They might be screaming buys, but I'll do further investigation. This is where we're adding more columns now to make it a more informed decision. So let's bring in the next ratio, profitability ratio. I always say if you had a takeaway shop, and I had to spend 50 Rand to make 100 Rand, am I profitable? Yes. Okay. Compared to a company where we have to spend 100 Rand to make 50 Rand. No. Ideal situation, I want to be investing into a company that spends 10 Rand to make 100 Rand. Okay. So one of the ratios that we like to use is a ratio called return on equity. The return on equity basically measures the ability of the company to generate profits from its shareholders' investments or shareholders' funds. So it shows how much profit each Rand of ordinary shareholders' funds it will generate. Okay, I always say it's the biggest, what will give you the biggest bang for your buck. So in our scenario, is the profit owed to shareholders. In this scenario, very simply keeping it at $1 million, and we've got 5.5 million shares in issue. In this scenario, my return on equity will give me 18.18% return on equity. Again, comparing it to the banks, what would you prefer? Investing at 10% in the banks or investing in this company and giving me 18%? I'd rather invest in this company. Okay, so most analysts will believe that a return on equity of less than 10% is unsatisfactory. Say for example, the profits had a drop to 500,000 instead of $1 million. Okay, we still got the same amount of same amount of shares in issue. In that scenario, 500 divided by that, by the 5.5, you'll get a return on equity about 9%. As I say, most analysts will say, nah, that's not satisfactory. So the ideal situation, you want to look for companies of 17, 18% will be considered very good, 20% will be excellent, whereas 25 and above will be superior. As I say, my scanning criteria, I'm looking for shares that are 15% plus, what's important for me is sustainable. You know, if a company is growing its return on equity at 50%, can they do that year in, year out? It's very unlikely. There are companies that do it, but very far and few between. But sometimes the growth rate will slow down. I like to look at 15% plus as a starting point. Okay, so that is our return on equity. So going back to our list again, so I've added another little column in there, return on equity. So you can see now return on equity, our anchor group, more than 50%. Now, Adapt IT as our highest so far in this little list. So it's undervalued, okay, and it's very, very profitable. Okay, and that's a 7 Rand share. So those of you that like the little penny stocks or the small caps, that's a nice little company to look at. So, okay, so let's look at manageable risk. In the good old days, we used to look at the debt equity ratio. And one way to compare this is like buying a property. I want to buy a R1 million property. The banks will ask you for 10% deposit. You put in 100,000 and you're the owner of the property, a R1 million property. But now, who owns the property at that point in time is the banks. Their equity is much higher than yours. But let's say you got a 20-year bond, 10 years down the line, you paid half your bond off already, you got 50-50. Now you can negotiate either better interest rates or you take your business somewhere else. Okay, so good old days, we used to talk about debt equity ratio. It's all your long-term and short-term interest-bearing debt, less your cash in the tills, plus the money in the bank, divided by the shareholders' capital. Okay, let's say, for example, we get to a situation, we've got 3 million, let's say 250,000 in the bank, 2,750 divided by 5.5. In this scenario, we get a debt equity ratio of 50-50. So is that good or bad? No, it's very good. But what's more important is, can you manage the debt? Yes, I can leverage it up. So we go one step further. We say, okay, what's better to look at managing financial risk is we use a thing called interest cover. Now, interest cover in this scenario is how many times can I cover the interest bill out of the operating profit? So, example, I got 1.8 million in operating profit, and my net interest paid, that's obviously the net of the interest received and interest paid out, is 315,000. In this scenario, my interest cover is 5.71 times. I can cover my interest bill 5 times, more than 5 times out of the profit. So this is one of the most important ratios to consider when you look at financial risk, especially if you're looking at the share in an AltX or a small cap stock. It's not so much about valuation. More importantly, is interest cover, as I say, financial risk. You can go one step further and look at cash flow and things like that. But when it comes back to interest cover, a 3 times cover, especially for a large cap, would mean that it's sufficiently covered to cover the interest bill 3 times. We say that's manageable. And that's a minimum investment, minimum interest cover we would look for. Small caps, I'd say 5 times plus. Okay, but anything below 3 times, I'll be seriously worried and I won't consider doing further investigation or investment in this company. So going back to our list again, here's your interest cover. You can see most of these shares are yellow. So you'll see that, yes, it's not the red, will be below 3 times, but it's highlighting 4.5, there's 15.4. Anchor Capital and Afrocentric have no debt. It's more than 100 times covered. Okay, so that just gives you that peace of mind also buying into a company that's moving from cash into shares, but this company is not going to go into liquidation. They've got manageable risk as such. Okay, I hope that makes sense. Let's talk about interest cover. Investment strategies. I'm running out of time here. But the idea of the investment strategy is just to have investment philosophy. What is your overall investment view? Remember, we say investment view, your time horizon is 3 years plus, so that's long term. The buy and hold strategy, you should be thinking along the lines of wealth creation, but ideally also think of different, I always say, buckets for different investment objectives. But the idea is that you might consider, am I using a top-down approach or bottom-up approach? I suggest maybe use both. Be aware of the macro fundamentals, but concentrating more on the bottom-up approach and using our technology on our website to help you scan the opportunities. Structure your portfolio. How many shares do you have in your portfolio? I'd suggest between 8 and 12, so it's quite diversified. You don't have too many shares. You have to spend your time analyzing those companies, or too little shares, or your eggs in one basket, and that's risk. Spread between 3 and 5 different sectors. It's no use having 12 shares and they're all in gold shares. That's too many, it's too much risk. So this is all part of your investment philosophy, investment strategy. Goes back to quality also. You're looking at more large caps, mid caps are the next 60 companies on the top 100 after the top 40. Anything outside the top 100 we consider that small caps. So that we talk about quality. So what kind of shares would you have in your portfolio? So I always say looking at sustainability, a quality rating above 60%. That's what I'm looking for. Timing of purchase and sales. We're discussing that next week in more detail with our technical analysis one. But also, how much liquidity are you going to have in your portfolio? I always like to have at least 10%. Why? Because if I'm fully invested and an opportunity comes along, then I have to sell one of my shares and I'm selling it for the wrong reason. So maybe consider having some liquidity in your portfolio. Remember also, I'm buying into companies that are paying out dividends. So what are you going to do those dividends? Are you going to withdraw it? Maybe it's after tax anyway, or are you going to reinvest and grow your portfolio? Those are the kind of decisions you need to make up front. So let's talk about investment strategy, and there are quite a few on the market on our platform. We talk about value investing, and I mentioned just now Warren Buffett. He's the world's number one value investor. We talk about using a growth strategy or GARP, growth at a reasonable price. You can also use a strategy where I'm looking for high dividend yield shares. I like to combine all three together in one little portfolio. I call it a fruit salad portfolio. So I've got some value stocks, some growth stocks, but most of them are high dividend paying shares. Okay. But the idea here with value investing is I'm looking for shares that are trading less than the intrinsic value or the true value. So I'm a bargain hunter if I'm looking at value investing. So as a value investor, I'm actively seeking companies that I believe that the market is undervalued. You find that sometimes the market overreacts to the top side and the bottom side. And this results in the share price that obviously does not correspond with the company's long-term fundamentals. The share might be worth 5 Rand and it's trading at 2.50 Rand. Okay, that's a bargain. I'll be rushing out and buying that share. Where alternatively, on the upside, it's trading at 10 Rand, but it's only worth 2.50 Rand. That's expensive. I'll be avoiding those kind of companies. I wait for the company to come back to more realistic levels. So I'm using various financial ratios to help me determine if the share is undervalued and profitable. Okay, so on our website, we've got a tool here called, you click on research, and there's a search button. And there's 3 little defaults. And I suggest in this situation, scan for undervalued and quality shares. So the share might have dropped, so they're undervalued, but also you have to look at, as I say, the quality of the company. So in this scenario, this is on Wednesday this week, it's split out of the 450 shares on the market, there were only 4 companies that met the criteria. So you see they're all green, and there's my legend again, undervalued, that's what I'm looking for. Okay, so this is what we call the value filter. Okay, same list of shares now. I can also click on the little tab called quality. And that's referring to the quality rating here. And that's where this criteria came in here. I'm looking for shares between 75 and 35. That'd be the PEG ratio. That'd be the greens. And I'm looking for quality rating above 60. So when I say quality rating, there are 12 different financial ratios, and some ratios will add more weighting to it, and hence the quality rating. That's how it all comes down. Okay, so that's how this will help you as a big time saver. Okay, to help you find the shares. But once you've got this, and I'm going through the process very quickly, just understand how to get to the situation when I can start doing further analysis and digging deeper. If you click on the share code of the company, in this situation, I'm looking at Tsogosan. I click on the share code to take me through to the share info page. So all the information related to one company is on one spot. So a big time saver. I'll go one step further. You'll find in the middle of the page here, there's 2 little tabs. Click on research, and under the research tab, you can find company analysis. Now, we have a team of analysts that looks at the market, and they write what we call a trade idea. Now, this was the last one based on Tsogosan, quite in depth. What's important here, you can see the color here, it's green. And also as a portfolio, they say up to 5.25% exposure in your portfolio. And there's all the reasons why. Okay, and I suggest go read up on it. Gives you more analysis, more ideas about the company. What I also find useful is this little triangle in the background here. There's 3 criteria. I'm looking at value, I'm looking at quality, I'm looking at confidence. Ideally, this black triangle should be forming exactly on top of that green. So they meet the value criteria and they meet the quality criteria. From the confidence point of view, this is management confidence going forward. We're slightly off there, but it's a starting point for you to do your analysis on the company. Okay, so quickly, what you can go one step further and compare, for example, Tsogosan in the beverage or the travel and leisure sector. I'll be compared to Sun International. But this is, for example, you want to compare a bank, First Rand relative to Nedbank or to Barclays Africa. This is comparing it to its sector. That's one way of looking at it. So remember, going from our bottom-up approach, I'm looking at individual companies, and then I compare it to its peers. This is part of that process. And I also go one step further. I personally like to bring my technicals into it. Yeah, I'm looking at Tsogo Sun now, and my criteria will be, is the share bullish? Is the long-term trend up? Is it oversold at the bottom? So yeah, we're looking at moving averages. He says bearish at the moment, so it doesn't meet my criteria. It is oversold. This is the MACD. It's giving a bit of bullish divergence. However, from a volume and an accumulation point of view, this is where I'm looking at institutions, the big heavyweights. These guys have been selling off, but yeah, it's maybe a volume distribution, might be a sort of a volume accumulation. So I want to see where's the big money moving to. So a bit of a contrarian approach here, where everybody else is selling, I want to be buying, and this is what we call relative strength. Tsogo Sun relative to the whole market. In this point in time, it's underperforming. So this is the extreme scenario. So you'll find the fundamentals and technicals don't really correspond, but this is actually one of the shares I'll have in my watch list and say, okay, this will be turning around very, very soon when people cotton onto the idea of the fundamentals. Okay, so that's just a very, very broad way of looking at as I say, fundamentals and technicals. Let's quickly summarize. As I say, I've gone over time. Hopefully I've achieved my objective of simplifying it for you and just highlighting the opportunities on the market and just touching very, very briefly on one investment strategy being value investing. So macro fundamentals, top-down approach, as I say, I highlight being aware of those 5 or 6 financial ratio, those macro criteria. I prefer more the macro fundamentals, a bottom-up approach, but maybe use both. Have a view of that. Value investing is one of the strategies I always found it works very well, but also be aware that there are some challenges with value investing. One of them being that you can fall into what you call a value trap. The shares just falling and falling. It's getting cheaper and cheaper, but that's why it's important to bring in the quality rating too. Okay, and then always do your homework. You're not just buying a share. You're buying into a company. What does this company do? So learn more about it. And that starting point would be that company analysis. Go to the individual companies' websites, go to the investor relations sections, and go download the latest financial reports on the company. Get to know about the company. So that's what I mean by due diligence. And also, I like to bring in the technical charts. And I say we're going into more detail next week, explaining that for you. Remember, as an investor, my goal is to build a long-term share portfolio that's going to outperform inflation by far, outperform the bond market by far. So my goal is to build up a portfolio on average, making more than 15% per annum, doing it consistently. That's your goal as a long-term investor. Okay, so as I say, just in conclusion, before I handle any questions, the presentation and the recording, the PDF will be sent out to you guys hopefully by Monday. I've been mentioning about fundamentals. Please go to our website and refer to the tutorials number 4, 5, and 6. Those of you that are still starting out, I also suggest look at maybe the first 2. What are the basics, and also how to prospect and create an initial watch list. Okay, so place some paper trades on the simulator. All of you have access to our simulator, what I call paper trading, and this is where you make mistakes. But learn from the mistakes, create a watch list, and then you fine tune it. Okay, next week Friday I'll be doing a webinar again. Those of you in Joburg, we have the actual workshop face-to-face on Wednesday night from 6 o'clock onwards. But next week, please go book for our webinar. Be very popular. I know more of you guys are traders than investors, but come along for that. Okay, let me handle quickly the questions before we sign off. As I said, I've gone a bit over time, but let me see what questions you guys have quickly. Okay. Wow, okay, quite a few questions here. Awesome. Here's a question from Daryl. My thoughts on interest cover versus debt service cover. Is that, I'm not 100% sure of debt service, is that a ratio? But to Daryl, answer your question very simply, I prefer interest cover. That just highlights for me how many times can interest bill covered out of the operating profit. My benchmark, as long as that ratio is more than 3 times cover, I'm happy with that. Hopefully that answers your question. Yes, I'll send you the presentation as well as the recording. Okay, cool. Okay, a lot of guys are rolling. What's the requirements for attending the workshop? There's no requirements, you just need to register. That's the main thing for us. Okay, Kumpalani, I hope that answers your question. Okay, cool. That's it. Awesome, guys. That looks like all the questions. Yeah, guys, for those of you that are in Cape Town, here in Joburg, I'm doing the webinars, the workshops every Wednesday evening. I'm coming into Cape Town, and it's the first time I'm doing a Saturday morning workshop. So it'll be from 8:30 till 12:30. So I'm combining all 4 sessions into one. But go into our website, guys, and those of you in Cape Town, it'll be in the Claremont Newlands area. We still have to confirm the venue, but the date's set for the 25th of November. Okay, 25th November, Saturday morning. Please come along to that. Okay. No, at this point in time, there's no workshops in Port Elizabeth or in Durban. We're just running at this point in time because it's near the end of the year in Cape Town and Joburg. But we'll see next year. Okay. Konsazani, hopefully that answers your question. We'll see in Durban. Okay. Cool. So that looks like all the questions. Cool. Okay, guys. Thank you very much for being on this webinar. I appreciate it. Let me get it out of the way. Yeah. Any questions you guys have, please drop the email to our wealth boxes. My whole team will be able to answer it for us. And there's also our phone number. So any questions you have regarding the market, regarding the content I've just spoke about now, that's how you can get hold of me. wealth@psg.co.za. Okay. From my side, thank you very much for being on this webinar. Until next week, all the best. Bye for now.